something that Margaret's just mentioned, and we've heard this in the last couple of days, and so I just want to talk a moment about dispelling fear. One of the challenges that we have as a firm is we need for people to understand that there are consequences to not being compliant with their U.S. taxes, but on the other side, we don't want to scare anyone. It's not meant to be a scary thing, but it's meant to say you need to gain some knowledge and get the facts. And so we talked about last night what would probably be everyone's biggest fears, and this is the feedback we had. And so the three things fall into the category of criminal implications, the cost of the penalties if you don't get compliant with your U.S. taxes, and the cost of getting compliant with advisors like us or like other people you may use in your local countries. So what we want to do is dispel some of those issues with you today, and you're welcome to talk to any of us, Anna, Joni, myself, Darlene, and Andrew, about just these issues. Please be as honest with us, as you want to be. What we want to say is, don't fear the consequences. Get the facts. Each individual is unique. We all have individual and unique circumstances, and this is the first steps to learning. So what we have is a presentation that is in a room. Some of you are more sophisticated about these issues than others. Maybe your circumstances are. So we're trying to find a balance of detail. We've heard some of the questions you've had the last couple of days. We've had feedback from Margaret. So what we want to do is get a combination of detail, of which we've got a lot more detail, if you need it, and individual questions you can ask Helena later, or some broader things that you may not know. And I think we're all learning, as the rules and laws evolve, we're all learning what that means. And I just want to add that about compliance, in the last 3 or 4 years, our firm has done more voluntary disclosure than almost anybody in Europe, simply because it's been a push by the U.S. government. So our offices in Switzerland and in London have done a lot of cases that would be similar to things and questions you may have. And it is evolving. The IRS agents are learning, as we were learning to work with them to do these things. So I'll leave it at that, and I'm going to hand you over to Andrew about an American's reporting responsibility.
Before I get started, we're going to broadly focus on 3 areas. We're going to try to cover in a broad spectrum both income tax and the state and gift tax rules. We're going to then look at some of the reporting requirements necessary under the new financial reporting forms, and then we're going to discuss the issues around voluntary disclosure for those that want to come forward and catch up on their tax obligations. Excuse me. The starting point from a U.S. tax system is you have to grasp that U.S. citizens and U.S. tax residents are subject to U.S. tax on their worldwide income. I've had a number of questions from people. They say, I live in Belgium or France, whatnot. I have no U.S. sourced income. Do I still have to pay tax? And the answer is yes. You have to look at your global income. The other aspect that I get in the questions are, do I have to report, my husband, let's say, is from Belgium, do I have to report his income? And the answer is no. He's not a U.S. citizen. He's not a U.S. resident. We're only focusing on U.S. taxpayers. I will, yeah.
Yep, that's our next slide.
The first grasp is citizens, and obviously, I think most of us realize if you're born in the United States, you are a U.S. citizen. It doesn't matter how your parents got there. If you're born there, you're one of us. If you're born outside of the United States of a U.S. parent, you're not constitutionally a citizen, you're legislatively a citizen. Our laws have changed over the years, and you have to actually look to figure out what the law was at the time you were born to determine whether our legislation picked you up as a citizen or not. And I think modern times it's basically been if your parent has lived in the U.S. for about 5 years, 3 or so after age 14, you're more than likely a U.S. citizen. We get people saying, I haven't registered my child. They're born here, but I haven't registered them with the embassy. I've never got them a passport. So they're not a U.S. citizen, right? And the answer is wrong. They're a U.S. citizen, whether you get them a passport or not. Excuse me. Green card holders, those with permanent right to reside in the U.S., they're just like U.S. citizens on the income tax at least. They're subject to U.S. tax worldwide, and they're subject to U.S. tax no matter where they live. The biggest problem for the green card holders is that they go into the U.S., they get their green card, they work there for several years, they then, for whatever reason, move back or move out of the U.S. They take their green card, they know it's not going to be very good for immigration purposes after about a year, and they just throw it in a drawer. They may not be able to get into the U.S. with their green card, but they're still tax residents. And you remain a tax resident under the green card until it is formally taken away from you, or you formally give it up, and that's sending it into the State Department, which they keep changing the department. There's a form that you fill out, you send it in, they send it back to you. If you go try to get into the U.S. on your green card and the guy at the gate takes it away from you, that's not enough, because you have a legal right to challenge the customs official. So we end up with a lot of people that they haven't paid U.S. tax in 20 years because they didn't know that they were still subject to tax. It is not great news for them. The other tax resident is not really relevant for this group, but it's anybody that's basically lived in the U.S. For more than 183 days, roughly. It's a bigger test than that. If you're not living in the U.S., it won't pick you up.
There's one thing I'd like to bring up on that point. We come across quite a few individuals who have worked abroad for quite a few years, and then when they retire, they go back to the United States. And they will go and spend maybe 6 months in the United States, 6 months in, let's say, Italy, UK, wherever. The issue is you have to determine where you're resident. Okay, under both jurisdictions, if you start spending 6 months in one location and 6 months in another, you cannot assume that you are automatically just a U.S. taxpayer, especially if you're spending 6 months or close to 6 months on average every year in that foreign location. And you really do have to look at your requirements, because you're going to be subject to U.S. tax no matter where you live. Okay, but the issue becomes where is your tax residency and whether or not you are subject to tax in the jurisdiction where you're spending on average 6 months a year. So it's something to seriously be aware of.
On the news today, there was a report about the internet. When you buy something on the internet, you have to agree to the terms and conditions. And you click the little accept or don't accept. And they were on about one that's apparently longer than most of Shakespeare's plays. And people just don't read the fine print. This is the fine print in your U.S. passport. And this tells you what we've just been telling you, is that you're a U.S. citizen, you're subject to U.S. tax on a worldwide basis. I've had a couple of questions, not U.S. tax, but state tax. There's 50 different states. They all have their own rules. Once you've left the state, more than likely you will cease being a tax resident or subject to tax in that state. But you need to check each state's rules. They're different. I'm from Oklahoma, and we had a rule that if you moved from Oklahoma to another state, you became a non-resident of Oklahoma, unless you moved outside of the United States. And originally, Oklahoma's rule was that if you moved outside of the United States, you remained an Oklahoma resident. Eventually, we got them to change the rule, so now it's a 2-year rule. Effectively, if you're outside of the state for 2 years, you cease being a resident. Some states look at domicile. Most of them look at residents in and out of the state, but do check with your own state officials, because I've talked to several people and they've been living outside of their state for 5 or 6, 7 years, and they're still paying state income tax, and I don't think they owe it.
There's, as expatriates, I would say California and Massachusetts are the two toughest states, and so is Vermont, believe it or not. California, and this happens more than once. California State, I had one client whose wife remained in California, and whose husband, who was the breadwinner, was actually living in England. California State taxed 50% of his income because his wife and his family home were also in California. So even though he was working abroad his entire, for years, he was subject to California state income tax, okay, on 50% of his income. So it's very, very important, the state laws, and understanding which state you came from. Massachusetts is definitely a domicile state, and if you have left, you have to be out of Massachusetts for 5 years to actually be clear of Massachusetts.
So the important thing is to find out which state you're from.
And New York, for instance, New York, you spend 10 days working in New York, you're subject to New York state income tax on those 10 days worth of earnings. So it's very important, the state laws. Don't ever forget the state issues.
And now we have what does an individual file? And so here's a listing of forms that some of you may know about and others of you may not. And Andrew and Darlene will talk briefly about them. It's just important to know that some of the things you think may not belong to one of these forms, I'll just tell you, the foreign trust reporting, you may think you don't have a trust, but for instance, I live in the United Kingdom, and my pensions are considered a trust, which I didn't know until this year. So I'm just bringing up that it's important to get the facts about these forms as well, because they may apply to you even if you think that they don't.
Your individual income tax return is your Form 1040. I think most people know that. And a lot of people say, but I don't work. Well, that doesn't necessarily mean you don't have to file income tax returns. If you have that joint bank account with your husband and he's a foreign national, by rights, joint means 50-50. Now, it doesn't mean you're paying income tax on the value of the account, or your husband's earnings that come in are deposited into that account. But any dividends or interest or capital gains that are generated within the account, if it's a brokerage account or an investment account, again, if you have a legal right to those funds based on the jurisdiction under which your bank account is held and where you're living, then you would be subject to U.S. income tax on 50% of the earnings of that. It doesn't necessarily mean that you owe tax, okay? There's a filing requirement, all right? Just because you have to file a return doesn't necessarily mean you owe income tax, ladies, because you do get a credit for any Swiss or German or French or Italian tax that is paid. There are treaties between the United States and those countries, income tax treaties. So it's very important for you to understand that. Okay? Now, the 1040 NR, that's mainly for foreign nationals who have invested in the United States, or who, basically, people who have invested in the United States. That's, not much really to say about that, other than the fact that we had one client who had invested about $250 million in 66 different partnerships and investments in the United States. And no one ever told her she needed to file U.S. returns. She was just, her Swiss account was just gathering all this paperwork. Did nothing with it. And so we had to bring her up to date with what's going on. She didn't owe any tax, but it's a matter of filing. If you don't file your returns, and there are losses, you can't carry those losses forward. So it's very important. These information returns are probably just as important because they don't require income tax to be paid. They're information returns, but they carry huge penalties for failure to file them. The 8621, which is your passive foreign investment companies, these are mutual funds, foreign mutual funds, and the U.S. government tries to equalize a foreign mutual fund with how a U.S. mutual fund is treated. I'll go into that a little bit later. The disregarding entities and partnership reporting, corporate reporting if you've got your own business, your own company. If you own more than a 50% interest, you're going to have to be filing that 5471 on an annual basis. Doesn't necessarily mean there's any tax due. It's just a balance sheet, income statement, and you look at the type and the character of the income earned by that corporate entity. The trusts, like Nora had said, most people don't realize that, yes, your pension, foreign pensions are not U.S. qualified pensions. So you have to look at the treaty, determine what is it under the treaty that I've got here, and whether or not I need to treat it as a foreign trust and file my foreign trust returns. Again, no tax due. It's just a 4 or 5 page form that says who the trustee is and the value of the account. This is with a filing requirement whether or not you take a distribution. Okay, it's just reporting the income on it, not the asset itself. Foreign financial assets reported this 8938 and this form 90-22.1. We're going to pull it up on the screen, not right now yet, later, and I'll go through it because all of you, being presidents of your various foundations and charitable organizations and whatever it is you've got signature authority over, I'm going to show you exactly how to fill in that form and where to put it. It's not a difficult form, ladies. You know, it's something that you can do. You don't have to pay, someone like us to actually help you fill in that type of a form. Anyway, so we'll go through it.
And with all of that, maybe you've lived abroad for a long time and decide that it's a hassle to keep your U.S. citizenship, which is a serious discussion, but we are seeing, and we've mentioned to everyone, we are seeing in Switzerland especially that a lot more people are deciding to expatriate. So we just wanted to take a couple of questions we had was, who pays this exit tax? So you may think, I give up my American citizenship and then I don't have to pay taxes anymore, but that's not entirely true.
When I joined the U.S. tax in 2000, and one of the first meetings I had was with Darlene and a client, and he wanted to expatriate. And the whole concept, I knew all the rules, but I never actually dealt with a true live body that wanted to give up their citizenship. And I really started getting angry. I got up and left the meeting because I didn't want to deal with the traitor. I've evolved my thinking over the years. It's now when people come in for just general tax planning, it's now a question I will routinely ask is, do you want to give up your citizenship? For those of us that live overseas long-term, particularly if we're married to a non-American, sometimes the U.S. tax system gets in our way of just being able to live our lives normally. And for a variety of reasons, we want to give it up. Like I said, in 2000, I met one person. I get about 3 or 4 phone calls a week from people who at least want to think about giving up their citizenship. Most of them don't go through with it because it's quite an emotional issue, but they do think about it. The U.S. Embassy has tripled its staff dealing with exit tax people just because of the volume of people wanting to leave. The problem with our system now is if you leave, you may not be able to leave without paying a tax. If your net worth is more than $2 million, and net worth is take the value of all your assets less all your debts, so less mortgages and any other debts you have. If your net worth is more than $2 million, or if you haven't been tax compliant for the last 5 years, when you give up your citizenship, you're subject to an exit tax. The exit tax there's 2 elements to the exit tax. The first element is you pretend as if you have sold all of your assets and calculate in effect, the inherent gain in all those assets. You reduce the gain by $630 some odd thousand. If there's any gain left over, you're taxed on the gain. The second element is that if you have any form of deferred compensation, foreign pensions, any form of deferred income, all of that income is treated as being received the day before you expatriate. So you can end up paying a substantial amount of tax with no cash to pay the tax. And the second really bad part of it is when you do realize the gains or the income in the foreign country, you will more than likely owe tax in that foreign country. They will not give you credit for the U.S. tax you've paid, and there is no mechanism to go back into our system and take a credit against the U.S. tax for the foreign tax you paid. So some people literally want to get out and cannot afford to get out. The other one you have to watch out for in this are the green card holders who have held their green card for more than 8 out of the last 15 years. As I said earlier, if you still hold your green card, you're subject to global tax. You haven't known about this for years, and somebody now tells you, oh, wait a minute, you should be paying tax in the U.S. Your reaction is, I want to get rid of my green card, and you're subject to the exit tax as well. So we have clients that literally don't want to be anything, but they can't afford to get out of the system. The exit tax is an area where, with some planning, you can manipulate your assets. You can through tax planning. If you'll be patient and take a couple of years, we can normally through some gifting programs and restructuring programs get you below the $2 million. If you've got 20 million, it's kind of hard to do it. But if you're at the 2.5 to 5 million area, we could probably restructure things to get you down.
So this is a subject, American marrying a foreign national, that's, I know, of great interest to you all.
Big issue here basically are interspousal transfers. 2 American citizens can transfer assets between themselves freely. No gift tax, no estate tax, no tax whatsoever. If your spouse is not a U.S. citizen, there is no freedom of transfer. For gift tax purposes, we can give away annually. This year it's $139,000. This amount gets adjusted for inflation each year. And again, for tax planning purposes, if we have a few years, even though that's not maybe a lot of money, we can transfer it over 4 or 5 years. We can move a lot of money out of the U.S. citizens' estate. I'll talk a little bit more about gifts in just a minute. The joint accounts.
Should mention joint
She's already
accounts.
done the joint accounts. Children, the biggest issue here. Remember, the minute the child is born, if they're a U.S. citizen, they're a taxpayer. So if they earn money, they're going to pay income tax on it.
This is one of the things that quite a few people don't realize is, grandma and grandpa may have set up accounts, in the child's name, and this is where the individual, if their earnings are, a minimum of $400, they're going to have to file because you're claiming them as a dependent on your return, and there's no reason why you can't just file or include their income on your U.S. return. So you don't necessarily have to file a return for the child. You can do it on your return, include the income. So it's interesting.
The other area we run into a lot is in the UK, particularly kind of, I'll say, generalized family structure. You have British grandparents. They've had 4 kids. One of those kids is married an American. They've had little bitty Americans. And the grandparents have set up a nice trust structure for their children and their grandchildren. These foreign trusts, the tax treatment of foreign trust payments to U.S. citizens it's extremely complex. It can be very costly if it's not done the correct way. So don't want to go into all the rules about it, but it's just if you've got a non-U.S. parent or grandparent setting up trust for your children, or you want to set up trust for your children, they can work wonders. They can do a lot of good things, but they need to be structured correctly to avoid some really unpleasant tax issues.
One of the issues with regards to trust that we see more and more, the problems with regards to expatriates, is in the United States, standard planning is to put things into a family partnership, or not a partnership, but a trust, to avoid probate. A lot of people do that and get their planning done before they move abroad, and then they move abroad, and they never really look at, well, what is that, how is that trust actually taxed in the environment in the country in which I'm living? For instance, just normal trusts. In England, if you set up, if you're in England and you have a U.S. trust of which you are the settlor and the beneficiary and the trustee, the entire trust is subject to UK tax. The entire trust. So you really have to look at your estate planning and any type of planning that you've done in the United States prior to moving abroad to determine whether or not that planning or those assets, the structure that you put together is valid or creates a serious problem in the country in which you're living. I couldn't emphasize that enough.
And then, Margaret, you mentioned that with
Country of residence.
from the German perspective, that the U.S. estate planning got totally mucked up because of the German tax rules. So it's a two-way street.
Always. Okay, investments not tax favored by the U.S. tax system. This is where I really would like to bring it to your attention, these foreign mutual funds. Ladies and gentlemen, a U.S. mutual fund, every year you get a 1099 if you buy Fidelity or whatever. Your U.S. mutual fund, you're going to be paying tax on your share of the interest, the dividends, the capital gain, short-term, long-term capital gain. That just comes out on your 1099 on a yearly basis, and you always include it in your income tax return. Well, foreign mutual funds, which are PFICs, passive foreign investment companies, those types of assets, you never pay tax until such time as you actually sell. Well, the U.S. government says, hey, that's not fair. That is definitely not fair. So they created a taxing system where you have the choice. You either agree to include as taxable income the incremental increase in value on a yearly basis. That's a mark-to-market election. Or you hold it, and when you sell it, then you pay tax. Let's say you held it for 10 years. Well, the top tax rate in the United States is 35% since 2003. Okay, prior to that, it was 39.5%. So you take the highest tax rate. Doesn't matter whether your individual return is in that rate bracket or not. You take the highest tax rate plus interest on that tax over the time frame that you held it. And a lot of times the tax plus the interest is going to exceed the gain that you made on your investment. So it's crazy, and you have a lot of brokers who have been told, do not invest in PFICs for Americans. Well, that's true, but to be honest with you, it also doesn't make sense for an individual who's only got $50,000 or $100,000 to invest to actually buy a regular stock and bond portfolio. There's an awful lot of risk in that. So as far as a PFIC is concerned, a foreign mutual fund, if that's what you choose to invest in, either agree to sell it in December of every year, which means you have to tell your broker, by the way, I don't mind holding on to those PFICs, but make sure you sell it in December 31 every year. Buy it back in January if you think it's a good one. Or you make a mark-to-market election on it, and you record the incremental increase in value on a yearly basis. So you don't let the tax man, choose what your best investment is. Go ahead, sorry.
There's informational returns, obviously, that go with all of those types of
Talked about
things.
that. Okay. The passport or green card renewal abroad. To the extent you guys are renewing U.S. passports, the IRS, all the information, your name, your address, and your social security number will be given to the IRS. And they will, of course, match it with their computers to find out if you're filing. And if you're not, then they will probably send you a letter that says, excuse me, did you forget to file? And maybe you have to, maybe you don't have to. But that information is very, very important. And there's proposed legislation that will prevent renewal of passports if you owe more than $50,000 in tax. So, interesting.
One of the things in the UK that crops up a huge amount, in the UK, when you sell your primary residence, you're not subject to tax. And for those of our clients who have lived in the UK for a long period of time, that has just now become a given. They just don't even think about the fact that the U.S. system US system is always there, always checked.
You're talking about a house not in the US, right?
Yes.
I'm talking about your primary residence anywhere.
Okay.
Anywhere in the world, any country, anywhere, it is still subject to US capital gains tax.
The other part of buying a house that really catches people unawares, if you have a mortgage in a non-dollar denominated mortgage, it's in a foreign currency, when you pay off the mortgage, from a dollar perspective, you will either pay more dollars than you borrowed or less dollars than you borrowed. If you pay more dollars than you borrowed, too bad, your problem. If you pay less dollars than you borrowed, the U.S. system views that as taxable income. People don't like it, but it's there.
It's basically a foreign currency gain or loss on the repayment of your mortgage, and you've got yourself a foreign currency more than likely, but you have a real gain or loss on the sale of your house as well. So, and if you get a loss on one and a gain on the other, you don't necessarily offset. Yes.
You said 250,000 of the gain.
Yeah.
Can we hold?
That's the gain.
Yeah, so I'm gonna stop for 1 second here, because we have 15 minutes left on the timetable Margaret set up. And this is to benefit everyone who have specific individual questions. And some of the things we're talking about now are selling houses and divorce and everything. So I'm gonna give everybody sort of an option here for the next 15 minutes. We have the specific Form 8938 form, which, as you know, is the new reporting form we have to do this year, or many of us have to do, and FBARs. We've had a lot of questions the last 2 days about FBARs. Now, we can either show those to you in detail right now so that everybody can see them and Darlene and Andrew can walk you through how you would fill them out, or to talk about voluntary disclosure. So this is something that's been talked about a lot of people here. What does it mean if you're not compliant right now? What are the options for coming forward? This is one of the things that we talked about dispelling myths about and the complications. Darlene has a lot of experience in doing voluntary disclosures with all kinds of people. Your situation she has seen. So it's up to you all now for the next 15 minutes. Do you want to see these forms in detail right now up on the screen, or do you want to talk about voluntary disclosure?
Voluntary disclosure.
Okay, can we have hands
down?
Yes.
Who wants to talk about voluntary disclosure? Okay, hands down. Who wants to talk about FBARs and?
Okay, so you know on the FBARs, if are the people on the FBARs, if you're not worried about compliance, voluntary disclosure, Helena can go in the back now with some FBAR forms and walk you through them.
Just also.
Would you like? I mean, that's.
Well, guys, really, it would take no more than 3 minutes to go over the 90-2.1. Let's just do it.
We can get you all these.
Because I think that is very, very, very important.
I just think voluntary
That hits everybody. So,
there you go.
all right. I don't know how much of this you can see. Woo! There we go. All right. Name, address, individual, okay? U.S. Social Security number. For identification, if you got a passport or whatever, you're not a corporate entity. You're individuals, you got your passport, you got your Social Security number. Your date of birth, name, last name or organization name. So your last name, your first name, your middle. Your address, your city, your state. Now tell me, you can't deal with this. This is not difficult. Does the filer have a financial interest in 25 or more financial accounts? Trust me, I am trying to get up to 25. I have 4 corporate entities. I have, but I still haven't hit 25 yet. Even with all my corporate accounts. So.
But if you hit 25, you check the box and that's it.
That's it. That's all you do. It's 1 page. But I don't have 25 yet, so I'm not there. Okay. All right, me, girl. What are you doing? Okay. Back up. Right up. You're giving me a headache.
Step farther away.
Okay. This is information for financial accounts owned separately. So if you own an account without your husband, just on your own, this is where you're putting it right here. The maximum value of the account during the year, the type of account. Is it a bank account, a securities account, or other? Name of financial institution, let's say UBS. account number, mailing address of the bank, financial institution, the city, the state, the zip code. That's it. That's it.
And I
It's
need
not
to,
difficult, okay?
and in the highest balance, I need to add, because your account's probably in a foreign currency, so you're gonna have to do the currency exchange to see what your highest balance is in US dollars.
Okay? That doesn't necessarily mean that you owe
No.
income tax on that. It just is the value of your account, okay?
Using the official treasury
Exchange
conversion,
rate.
yeah.
On which date?
They give it to
The
you.
date of
They
the-
give it to you.
the date-
December, no,
End of the
just
year.
use December 31.
Yes.
If you're filling it out for a club, and you have signing approval,
Just,
that-
we're getting there. Part 4. That's it. We're on part 2. Okay. Keep going. Part 2, part 3. Okay. Yeah, no, that's still separate. Okay, here, part 3. Okay, this is for joint accounts. Okay, where you have your American, well, if you've got both husband and wife, you only have to do this, both Americans. But if you've got a foreign national spouse, this is where you're gonna go. It's the year, taxpayer ID number, last name, again, value, maximum value of the account, not your 50% interest, 100% of the value of the account, even though your husband is the only one who's putting money in. It's 100% of the value because you have signature authority on the account. Financial institution, account number, mailing address, city, state, etc.
This is the one
Number
that's
of-
causing the most problems
Yes.
with married couples married to a non-resident alien. The
Yeah.
husband doesn't want this information going to the US.
Okay, but that's the life of the big city, so
It's either,
you're gonna have to go back to the girls.
you're gonna have to undo the joint account, or you're going to have to report it.
Yeah.
Or you come talk to us about divorce, which we missed the slide.
Okay, the number of joint owners for this account. I have an account where my mom, my brothers and sisters are all on the account. Okay, those are all joint owners. So this is where I would put this on there. Okay? Last name, organization name, principal joint owner, name, address, city, up,
Right.
up.
Down.
I'm like, yeah, there. Okay, again, maximum value of the account.